Hello, everybody. This is Rick Geiler with SilverSide Insurance Marketing here in Tempe, Arizona. And for today's presentation, I have on with us again Tony Fiorillo from Asset Management Strategies in Indianapolis, Indiana. He's going to give us his take on the equity markets and the upcoming election and how all that wraps together. Thanks for being with us today, Tony.
My pleasure. Thanks for having me, Rick. You know, one of the questions I hear very often recently is, what's the presidential election or this election cycle going to do to the stock market? That's a really good question. We've got a couple of really good choices this year for our presidential election. I think somebody said it's the devil we know or the doofus we don't know. And I can't believe out of 330 million people that these are the two best options that we've got. But such as it is, here it is, and we've got to deal with it. I was telling somebody the other day that I was a victim of these scary clowns that were going around. I had a couple of them looking in my window the other night for over an hour, and then I realized I was watching the presidential debate on my television set. But anyway, the markets, before we look at what the markets might do after the presidential election, I thought we might take a look at what the market may be telling us about the presidential election. And there's an interesting study that goes back to 1944, and it looks at the the S&P 500 from the end of July until the end of October, right before a presidential election. And if the market is higher, then whoever the incumbent party is holds that seat. Even if it's a newly elected person of that party, the incumbent still holds it. If the market is lower, then we want to change. And it's just common sense. I think if you look at that time period, if the market is positive, people feel good, we're moving in the right directions, they're not causing any panic, and if the markets are down, people feel a little more negative, and they are ready for a little bit more of a change. It's interesting on the upside. If the market is up and the incumbent, whether that's a Democrat or a Republican, retains that seat, there is 82% accuracy in that happening if the market is higher at the end of that time period than at the beginning. If the market is lower and we vote in a change, that has an 86% accuracy rate. Pretty amazing. So where do we stand? The end of July, the S&P was at 2173. Today we're just slightly over 2140. So we're just behind with 20 days left to go in the month, and we're short by about 1.5%. So we only have to have about a 1.5% increase in the market for the S&P to be higher at the end of August, and that would mean that we're very likely to have a return of the incumbent party, which would mean that Hillary Clinton would win. If the market stays exactly where it is between now and the end of the month, or sells off, then with an 86% probability, it means we're going to have Donald Trump. So that's interesting. The couple other slides that I found interesting were looking at not just the presidential election, but what happens with all of the other elections down the line. So this chart looks at what happens if we have the House and the Senate in the same control. And historically, year over year, since January 1900, the Dow Jones Industrial Average has increased in the following year by just over 7% if the Republicans have the House and the Senate. If the Democrats have the House and the Senate, that number of production for the Dow Jones Industrial Average from one year to the next is just under 6%. Doesn't look like a very big difference, but statistically it's a pretty meaningful difference, almost 50% more. And if we have a divide between the House and the Senate, Republicans and Democrats, it's lower. And if we have the Democrats and the Senate, the Democrats and the Republicans opposite that with the Senate and the House, you have a time where returns are dramatically lower. There's not much explanation or rhyme or reason for why that would be. But another way to look at that is if we look at time periods for the presidential election, the average return for the Dow Jones Industrial Average after the presidential election is a 7.6% increase. If the incumbent party wins, whether that's Democrat or Republican, if the incumbent party wins, market tends to go up 15.1%, whereas if we have a change where the incumbent party loses, the market tends to go down 4.4%. I think that reflects the general sentiment that if we are carrying on with the current plan, different personnel, but current plan, that the markets seem to behave better and move in the right direction. When we have some reversal of that, when we have a change in the incumbent party, then that change can be immediately somewhat disruptive to the markets, and you see the decline of 4.4%. Historically, the market likes the Republican wins at a 10.3% average return relative to the Democrats. It's generally thought that the Republican Party is more of a pro-business stance. Again, looking, though, at not just the presidential election, but looking at what happens when we have a mix of the two. When we have the Democratic president and Republican Congress, the market goes up on average 21%. When we have a Democratic president and Republican Congress, when we have a Republican president and a Democratic Congress, it only goes up 4.5%. And when the White House, the Congress are controlled by the same party, the market goes up an average of 12.1. If either party in the White House, but we have split the Congress and the Senate, then we only have a 7.1% return, which refutes the myth that the market likes to have this divided government. And that's certainly not the case when you look at when you have the Senate and the Congress in sync, and especially when you have it in sync with the White House. So interesting. Of course, the argument could be made that the stock market is more a result of political actions taken by a previous party, or the contradiction to that argument is that it's a forward-looking, the markets are generally forward-looking, and it's more a reflection of where they believe the economy is heading, 6 to 12 months down the road. So, I officially declared myself a political atheist many, many years ago, so I don't really have an axe to grind here, but I do favor more of the fiscal responsibility, so I'm not sure which party that is anymore. But and I think what a lot of people net result is more confusing information. There isn't any rhyme or reason. There isn't any one thing that we can definitively look to and say that this is absolutely positively going to happen because this is going to happen. It's pretty surprising that you have this high probability depending on where the market goes from the end of July to the end of October, but that general overall sentiment makes sense when you look at the overall presidential elections. But I think the saving grace here, because I'm not sure that this election cycle we have a good choice. It's the lesser of two bad choices in many people's opinion. But the overall faith in the inefficiency of government to do anything may be the saving grace in this whole argument. And the result may be that we have little effect and that that it's more business as usual. It's surprising, from what I hear in the background, there is a tremendous amount of support for Trump on Wall Street, and I think that reflects, what may be a more important question of what's this election going to do to our stock market, around to what's this election going to do to our industry. And I think that most people would agree that if Hillary Clinton gets elected, that the DOL rule is probably significantly less likely to be changed, and if Donald Trump gets elected, that rule is significantly more likely to be changed. And if our industry hinges on this DOL rule, which it looks like it very well might, a couple of news stories out recently. Last week, Merrill Lynch announced that they would pay zero compensation on any qualified account commissions. So there are very quickly estimates that they could lose 50% of their sales force just because of that stance. I think Morgan Stanley came in very quickly and said that they would they would allow commissions to be paid as long as they abide by their best interest contract agreement. So Merrill Lynch may have a change of heart when they see how many people want to jump ship from that. We'll see. Another article recently from Rick Edelman, who is a nationally known registered investment advisor, has a radio show, dozens of best-selling books. He wrote an article estimating that 50% of the advisors in our industry will not survive this DOL rule. So that's bad for the 50% if the number is actually that high. And I think when you look at the mean, it may be that high. I would argue that the 50%, if the number is that high, that the 50% would be the lower producing end of the business, certainly. But if that happens, then imagine how much more business there would be for the other 50% that survive. I don't know that the number will be that strong. I've heard initial estimates of 20 to 25% of the broker-dealers will go out of business. But, you know, there's a wave of information suggesting that people are going to raise their minimum account sizes, that, you know, people are just going to get out of the industry, and that would contribute to this argument that Rick Edelman's making. So don't know what's going to happen there. We know that we're going to have to deal with it one way or the other, and we're preparing to do that. So that's all I've got with the update on the market. I know I probably left you with more questions than answers, but such is the beast this year.
Hey, that's great information, and yeah, there's at least as many questions as answers. But I'll go ahead and invite anybody who has any questions specific to what we were talking about today, or more interested in getting additional information on how you can work with SilverSide and AMS on our integrated approach. Go ahead and give us a buzz here, 480-998-1286. And thank you so much for that insight today, Tony. We'll be back with everybody soon.